Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone. Welcome to MacroEdge Radio. This is John Galt speaking live on a Friday night, the end of November. And I have to tell you, folks, it has been one of the most interesting months that we have been through in markets, the economy, politics, and anything else you wish to sit there and talk about. It has been crazy. And when I say crazy, let's go through the numbers real quick before I bring our guest up tonight, Ross Hendricks. It is going to be an interesting show from a macro perspective and a market perspective. Today was an indication of bizarro land. For the month, the Dow was basically flat. The S&P was down 0.6%. The NASDAQ down 2%. Gold up 7.2%, all-time high nominally at 42.54.90. Silver up 21.3%, also an all-time high at 57.16. Bitcoin took it in the teeth, down 19.5% to 90,939. We'll talk about that during the show briefly because it is becoming a make or break kind of situation for the cryptos. So why did the rally occur in the last several days? Well, I'll give it to you quick. What I reminded everyone, the real money, the big money, the people with bank accounts that you and I can only sit there and read about in the news, they went on holiday last week at noon, last Friday at noon. Very thin trading throughout the week. The fake news data was there to pump rather than report data. So we had fake, ridiculous news, as our president likes to say. Some of the economic data you have to start questioning when the PMI comes in at 36 and all of a sudden we see huge rallies. But the real truth is only one piece of economic data mattered, and that's the Japanese yen. It didn't get above 160, so the crash stopped. With that being said, we can start looking forward to December, where the first 2 weeks, in this humble host's opinion, are going to be some of the most violent trading sessions one will see. And when I say one will see, I mean it's going to get really colorful really fast in the first 2 weeks. From Texas, who is sacrificing the Aggies versus the Longhorns, unless he's a Texas Tech or SMU fan, Ross Hendricks from the Big Secret on WallStreet.com, Porter Company Research.com, known on X as Ross Hendricks. Can't miss that when you search. So welcome aboard, Ross, and welcome to MacroEdge Radio.
Yeah, thanks, John. It's great to be here. I know we've gone back and forth on Twitter a few times, so it's great to. I've listened to a few of these spaces before, so great to be a part of it.
Well, it's great to have you here because really, this is one of the most interesting times in economic and market history because we're on the brink of doing some really stupid things. But what did you make of this month end?
Well, I definitely for sure agree with you. We're on the brink of some really stupid things. I think it was. I really think you can boil it down to as simple as they wheeled out Fed President, what was his name, Williams, on the 19th. Right as the market was looking like it was about to enter meltdown territory, in my opinion. It was, the day after the NVIDIA debacle earnings report, which was actually really solid on the, there was nothing not to like in the report. I think it was kind of one of those hallmark days in the market where nothing but good news, nothing but Jensen Huang's most exuberant forward guidance, and the stock just opens on the highs and sells off, just brutal sell-off all through the session, and really hasn't recovered even with the market ripping the last few days. So I think if you look at what the sectors that have really outperformed, I mean, you're seeing strength in things like home builders, which I think is really kind of puzzling, but it's just a rates play, in my opinion. I mean, the home builders are looking at a disaster in 2026, in my opinion, and it's hard to have any reason for optimism in that sector. And so you're seeing these names just catch a bid from rate expectations. I think they flipped from like 30% to 80% after Williams made that comment on the 21st, and that was basically the stick save of the market that Friday. So I just think, yeah, the market was looking weak. It looked like this AI trade, which is kind of the one theme keeping this market afloat, was coming under some serious question. And this just exuberant last few days we've had, I think, is just people trying to front run this December rate cut, which I think is probably going to be a mistake, but to be determined.
Oh, I 110% agree. I mean, this rate cut that's forthcoming, if it does occur, is an indication of submission to the president. And that was one of the questions I had for you tonight. So let's go right into that. Do you think we will see this rate cut, which indicates paralysis and fear, or people trying to win the job as Fed chair, a big interview process? Or do you think there's a possibility that Powell will try and reestablish the predominance of the Fed over monetary policy and decisions by siding with the hawks and saying, maybe we should pause because the inflation data, which realistically is higher than it should be, is much higher than their target rate?
Yeah, I mean, that's where it gets tricky in trying to game out what the different factions of the Fed are going to look like. I lean towards, I think we're just going to be heading towards lower rates, mostly because I think we're going to start to see a lot of weakness in the labor market. I mean, we're already seeing weakness in the labor market under the surface, and I know we haven't had a jobs report in a while, but if you look at some of the reports from ADP, for example, they're now producing a weekly series. I think the last 4 weeks in a row have been negative. And I think if that trend continues, I think there's going to be no choice but to cut rates. And then you've also got this, I think the interest expense is going to be the biggest factor that's going to force the Fed, whether they like it or not, I think we're gradually just going to be going down throughout 2026. And I think we're probably going to settle in somewhere that it helps manage what I think is really becoming the number one biggest story, or it's going to become the biggest story in financial markets over the next half decade and beyond, which is the U.S. government is just slowly going insolvent, and it's going from slowly, the bankrupt, the line, how did you go bankrupt slowly then all at once? I think we're in this transition period where everyone's known the debt has been a problem for a long time, and it hasn't really mattered until we've gotten to this place where interest expense is over $1 trillion a year now. And I just think that that's going to be the dominant force that eventually, politics aside, the Fed is going to be forced to capitulate and just bring rates down to a point where the federal government can actually manage to pay its interest bill and it kind of extend the runway between now and whenever we get to the point where we literally can't pay our bills anymore. And I think that's going to happen sooner than we think. And so it's hard to game out the short-term political factions, but I think that's the long-term force that's going to be pressing the Fed to lower rates over time.
Which I believe is going to be a fatal mistake, not for the dollar because it's sort of locked in, because we can use yield curve controls to sit there and negotiate that issue. But the bigger issue I see is we're basically cutting into a black hole. We've been hearing the braggadocio about the tariffs covering the debt and going to pay everything off, yet we don't even have enough coming in tariffs per month at the current rate to cover the interest expense of the debt, nor will we if we have to start issuing refunds. And looking at what China had all of their tariffs reduced back to pretty much pre-April Liberation Day levels. So we have to start wondering what policy influence the Fed really has on stopping this insanity, or are we just going to issue treasuries to ad infinitum and dilute the value of long-term treasuries?
I think it's the latter. I think there's nothing stopping the federal government's runaway. I mean, if you look at the biggest line items, you have Social Security, Medicare, Medicaid. Those are basically baked in to increase indefinitely over time. There seems to be zero appetite whatsoever to cut the military budget. And Doge was obviously a complete joke, despite all the hype around it and all the optimism. And I think there's no way around a default on treasuries over, let's say, at some point in the next, starting probably in the 2030s. And the way that they're going to default is not with an actual, we're not going to pay you, let's talk to our creditors and restructure the debt and have an honest discussion about entitlements and how we can right size the program. They're just going to print their way out of it. And so it's going to be the standard sort of playbook that governments have used for thousands of years, which is to default through devaluation. And I think that's the story that gold and silver are trying to tell us. And I think it's becoming almost a necessity that every investor has to have some allocation to precious metals or some other. I think there's various, if you can own high quality equities that can keep pace with inflation, that's an option too. But I think you have to have some sort of leverage to basically protecting your purchasing power, because I just think that's the only way out at this point.
I 100% agree. And here's the thing. We're repeating the 1970s style process where we basically defaulted on the dollar by coming off the gold standard. And Lionize, the designer of that, one of the lead designers in that, Paul Volcker. We have Jay Powell, who wishes to be remembered as the modern era Paul Volcker. But what we're looking at now is it seems more like the traders and the political class have taken over the management of our debt and of the treasury market versus allowing the market to actually decide the price and proper rate. That's a pretty scary prospect over the long term, what you're outlining.
Yeah, I mean, it really is. It's a sad state of affairs, and we can all scream from the rooftops as much as we'd like for things to be different. I mean, I think we're still not, I don't think, past the point of no return. I think you could right size this situation. Like I said, you could work out a entitlement reform where you basically do some sort of means testing and you cap benefits for people earning over a certain amount. I mean, there are solutions, and you could, I think honestly, if you were to privatize Medicare and Medicaid, it'd be extremely painful for a few years while we figure out how to get, transition to a new system. But that's the other thing, is that by putting this healthcare system under the government's control, that is what's causing this runaway cost inflation. It's just built into the way the system works. And so as long as the government's running Medicare, Medicaid, as long as they're running Social Security, and as long as we're going to commit to having, the biggest military empire in the world, there's just no way to manage the finances of this country. And there are real solutions out there, but the sad part is there's no politically viable solution, that people are not going to vote to get their entitlements cut. They're not going to vote to, change the medical system in a way that is painful and probably eliminates some benefits around the edges in the short term, even though we'd probably get much better care for much cheaper if it was in the private sector. But it's just not, I don't see any political candidates out there that are even really seriously talking about any of these major issues. And so, yeah, I just think the basic math of the situation is we are barreling towards insolvency, and there doesn't seem to be any serious attempts at, changing course.
Sort of sad that I have to make this statement, but so as an investor, be it in precious metals or whatever, do you not have to take advantage of the stagflation/inflationary scenario that you just presented?
Yeah, I think you do. I think it's almost like you just have to invest just to stay in line step with inflation. It's more about just protecting purchasing power at this point. So yeah, I mean, precious metals have obviously been a huge winner this year. And I think silver in particular is looking like, to me, that's the one that's got the most upside right now. You just look at the gold and silver ratio. It's if you look at, well, I guess if you look at the historical bull markets in gold and silver, you could technically count the start of this bull market if you really want to extend it back. I mean, it began in the early 2000s when we first entered the close to zero. I mean, I think we cut rates to 1%, which at the time was a record low coming out of the tech bust. And I think that was really the start of what this secular gold bull market is. More recently, you've had gold go from 2,000 to 4,000, and silver is looking like gold's been making new highs for the last couple of years, and we're just now at the point where silver is starting to break out and make new highs. And I think we're getting into this kind of later stage of the bull market where silver starts to play catch up in a huge way. And yeah, I mean, this chart just looks beautiful in my opinion. I mean, we're breaking out to above 50 for the first time really since you had the one spike in 2011. That was sort of a big head fake. You had that, cyclical downturn in the broader bull market. And then before that, the Hunt Brothers squeeze. And now we're basically got, blowing through those two previous peaks and nothing but open skies ahead. So I think silver is about to play catch up to gold in a huge way right here.
Silver and gold are definitely making those who are long-term believers very, very comfortable in their purchasing power. When you look at what else is happening, do you have to start questioning how the markets themselves, the equity markets, and we're going to get to the AI portion of this and circular finance later in the show, but do you have to start questioning the lack of oversight, not just from Washington, D.C.? We knew we were going to have reduced regulatory oversight from Trump when he got elected. He told us this. But also the Federal Reserve really not enforcing any regulation at all, whether at the Federal Home Loan Bank level, at the Fed in New York or the various branches. It seems that we've abandoned oversight of the markets and allowing a lot of high-risk garbage to be presented to the public simply for the purpose of getting private equity bailed out in the long term.
Yeah, I mean, I think that's basically, the real mandate of the Fed is to prevent any sort of pain or contagion in the financial sector. I think that's their real mission, and that's why you saw things like in COVID, they violated their, all semblance of their legal mandate by buying junk bonds, for example. I think they even bought the corporate bonds of Apple, and it's like, what did Apple really need Uncle Sam to come in and buy their debt? I mean, that was really, I think we kind of crossed the Rubicon with the starting with that collapse in April 2020 when they went crazy, and then obviously the massive monetary expansion that we're still dealing with to this day. So I think when push comes to shove, that's the other reason why I think this devaluation story is not going anywhere anytime soon, is because we do have a lot of problems in the credit markets and private credit in particular, and I think that they're going to do everything they can to prevent any sort of real pain, because I think we're in this era now where they basically create the bubbles by bringing the cost of money down below the natural rate, and that causes a lot of distortions and a lot of misallocated capital. And then when the chickens come home to roost and things start blowing up, like we're starting to see around the edges with some of these private credit bankruptcies and obviously the AI bubble, if you start to see any real pain in any part of this financial markets, I think they're going to be coming in guns a-blazing. I mean, I don't think that there's any tolerance for any sort of a correction or any kind of problems creeping up in the financial sector. We saw that with the Silicon Valley Bank bailout a couple of years ago. They just have no tolerance for any kind of market repricing or cleansing of the system.
So with that being said, the other risk factor I see for equity players, and I'm not classifying you by that by any stretch of the imagination, but by the masses, the retail getting into it. One of the things that the MacroEdge team's been highlighting, and we've talked about this online. If you don't follow us, we're on X, Ross Hendricks. Can't miss it, guys and gals. We talk about the lack of data integrity, not just from the government, but from corporations and their reporting. And we see it in the 10Qs, AKs, all the filings we see are just spectacular acts of fiction in many cases. We talked about this with Dario a few weeks ago. We've talked about it with Ed Dowd and others. Your concerns about this as a strategic investor over the long term, does it not make picking out stocks or sectors to play with or invest in a very dangerous proposition?
Yeah, that really is the biggest challenge right now. And in particular, it's this AI trade is where you really get into um, it's a very dangerous time because we've never seen the market so concentrated, so dependent on this one theme, right? I think we've looked at if you tally up sort of the Mag 7, plus a few other of the high value chip names like Broadcom and others, and then you add in the power players and the utility providers. I think something like 40% of the S&P 500 is now basically part of this AI trade. And there are a lot of questions about the financials in terms of, obviously the biggest kind of thing making headlines these days is Burry talking about the depreciation schedules on these NVIDIA GPUs, which I think is there's a lot of people dismissing it, but I think could be a real issue. But I think even if you take the depreciation at face value and say, okay, all these chips that we're spending $400 billion a year on, let's say that they do have the useful life that these companies are stating, which is roughly 5 to 6 years. You're still looking at a real issue with these companies, in particular the Mag 7. They've basically transformed their business models from what was previously a very capital light, high margin, high free cash flowing business model towards this new AI business model, which is really the complete opposite of what made these companies so great in the first place. And it's not even really, you don't have to look too far in the financials to see that the earnings quality of these companies is really deteriorating. And I think that's going to become a real big issue. Even if you take all the accounting and the depreciation at face value, you look at a company like Meta, for example, I think this is going to be one of the first companies that actually has to pull back on their big CapEx plans. And there's reasons for that we can get into. But if you just look at, for example, Meta, as recently as 2023, before they went really all in on this CapEx binge, they were converting 120% of their income to free cash flow. And that's just a great business because you're generating a lot of profits and you're not having to invest a ton of capital to keep that profit stream growing. And so that's cash flow that can come back to shareholders through buybacks or dividends. Not that they pay a lot of dividends these days, but it's just a very high quality business model that deserves a premium valuation multiple. And then you fast forward to this last couple of quarters, and this big CapEx binge is just eating away at their earnings. And so now Meta's in a situation where they're only converting less than half of their income each quarter to free cash flow. And I think that's going to become a big problem. And that's the same story across the hyperscalers. So if you look at just as one statistic, the combined free cash flow for Amazon, Google, Meta, Microsoft, it's actually down based on the current estimates going out to Q1 of this 2026 next year, their free cash flow is going to be cut in half from just as recently as Q4 of 2024. And so one of the things that people don't the market's not pricing in right now what this means for these businesses on a long-term basis, because these companies are not saying that this is a one-time investment, and we know it's not going to be one time. They have to continuously buy more and more GPUs every year, and that's what they're telling us they're going to do. And so you're getting to a situation where these companies have transformed from capital light tech monopolies to something that looks a lot more like a Verizon or an AT&T. And so you take a Microsoft, for example, they're spending 30% of their revenue on CapEx, which is actually twice as much as Verizon. And at some point, investors are going to, okay, so then just to back that up for 1 second, if you look at what Microsoft trades at, so one of the big arguments that people say is, oh, it's not anything like the .com bubble, the valuations aren't nearly as crazy. And the pushback that I would say is, well, there's two ways you can have an investment bubble. It's either in the P or the E in the PE ratio. So in the .com era, the bubble was in the P. These companies traded to crazy PE multiples, and then when that bubble collapsed, you actually had a situation where, as the .com bubble started to collapse, companies like Microsoft, it's a good example because it was front and center of both bubbles. So we have a good sort of comparison between then and now. Microsoft actually grew revenues all through the dot-com collapse. And what happened was the investors just said, oh, well, you were trading at 60 times earnings at the peak. We're going to bring your valuation down to 20 times at the lows. So that's what caused Microsoft to have such a bad 60% drawdown or whatever it was during the dot-com bust, was just the valuation compression. But if you look at, so my argument is that right now what you're seeing is a bubble in the earnings, not necessarily the price to earnings multiple. It's these earnings that they're reporting are not necessarily real and not sustainable, and they're being inflated. And if you were to instead look at these companies on a price to free cash flow multiple, they look a lot more expensive. And I think that's the key that investors are going to start to price these companies on, because if you become a capital intensive business, you have to factor in all of that capital that you're spending. That's earnings that's not available for shareholders. It's going into a black hole of data center capex. That is what they're telling us, is that this is not a one-off expense. This is how these businesses are planning to operate for the indefinite future. And so if you look at where Microsoft's trading right now, or at its recent peak before it had its latest drawdown, it peaked at 54 times free cash flow. And that is just a little bit below the 62 times free cash flow that it peaked at in December 1999. So I think if you were to look at these companies on that basis, you'll find that, look at a Meta trading at 36 times free cash flow, a Google at 52 times, Apple 42 times, Nvidia 56 times. These are pretty lofty valuation multiples. And I think that when the dust settles, investors are going to demand one of two things. It's either we need to see some returns from these investments that justify all this capex, or you're going to have to pull back on it, because we're going to basically do like what we saw with Meta when they went on their metaverse capex black hole back in 2022, and investors just revolted and they said, we're not going to be willing to pay to own this stock when you're going to take all of the earnings that you're generating and throwing them into this science project that's not generating any returns. And so if you get to that situation and these companies do pull back on the capex, that's going to ripple across the entire market, because you're going to hit Nvidia is going to get hit because they're not going to be selling nearly as many GPUs, the power providers, the utilities, and the hyperscalers that are getting all of this revenue from the cloud computing that they're selling to companies like OpenAI and Anthropic. That's the third part of this stool, where there's very good reason to believe that OpenAI will not be able to continue torching tens of billions of dollars of investor capital that feeds into the data centers that companies like Microsoft are building, and Amazon and Google. And so if you get to a point where this capex bubble is questioned, the earnings will evaporate, and you're going to be looking at a situation where it's not like the dot-com, where the earnings continue to grow through the cycle. You actually see earnings drop, and that's where I think the real risk is in this market.
But do you not feel that their cash flow models and their modeling for their earnings is based on the false assumption, same as the U.S. government, by the way, that we will not experience any kind of recessionary impact on the consumer, whereas right now we're already hearing the stories about the consumer cutting back and going straight for basics with very limited Black Friday extravagance per se, as compared to the past few years.
Yeah, and that is the other big risk, is that people treat the hyperscalers as if they're some sort of a recession-proof business. And the truth is, if you look at all of these companies, Meta and Google, they make most of their money from advertising. Amazon is obviously exposed to retail spending and with their cloud business. Microsoft is enterprise software sales, and cloud computing itself, it can also. So I think the hope is that the cloud revenue continues. That's sort of the idea that this is the secular AI trade, where this massive demand for compute power is going to keep the cloud segments of these businesses going, even if you get some kind of weakness with digital advertising and things like Amazon retail sales, for example. But the truth is, the cloud business is also at risk of, basically, if so you have that recession risk to the one part of the business, and then if you the other part is, I mean, why should we expect that OpenAI can continue to spend, or why should we expect that they're going to make good? I think they have $1.8 trillion in spending commitments going forward. And that's kind of the big hope that is baked into the cash flow projections of these companies like Microsoft, that they're going to continue to build data centers, that they're going to rent that capacity to companies like OpenAI and Anthropic. And that's sort of the non-cyclical revenue source. But I don't see how you have a company that's burning. I think in the most recent quarter, Microsoft, through their equity investment in OpenAI, you can back out that OpenAI lost basically $11.5 billion in that single quarter. And so why should we believe that that can continue indefinitely? That seems to be one of the biggest flaws in this whole projection of the cloud computing windfall that these companies are earning right now.
And with that, we're going to pause because we're going to go back to this subject as it's near and dear to everyone's heart, especially not just the hyperscalers who are hyper overrated, but also to the Mag 7 and some of these PE ratios, which are off the charts stupid, and what he was talking about with OpenAI. But first, this real quick break, macroedge.net/ozone, macroedge.net/ozone. You can get our interviews. You can get a free 2-week trial there. Check out what the team has to offer. I haven't been writing as much because I've been somewhat busy. I'll be re-engaging this weekend. You will also get to sit there and hear more from very exclusive data analysis that we're not sharing with the public on a mass scale. Pay attention. And Ross, tell us where they can find out more about yourself and the services you offer.
Yeah, so I work for a company called Porter & Co. We do financial research. We have long-only investment services. We have a distressed bond publication, biotech. And I run something called the Trading Club, which is a real money account that puts our own money to work behind our recommendations that we send to subscribers. And we always give our subscribers 24-hour notice before we make any trades. And we're having a great year so far, up about 15% since we launched in May. May 30th was our launch date. So we are actually opening this up for new memberships next week. And if anybody would like to join, you can send me a DM and I can get you a special discount. We open it up once a quarter because we do trades on a quarterly basis. And so it's basically open for 1 week every quarter, and we're just opening it up next week.
Fantastic. Well, I'm going to pick on Meta and beat the hell out of Zuck, because he's an idiot, in my opinion, with some of the stuff he's done. His CapEx binge has been a disaster for the company. We could start off with the VR failure. That came and went with the virtual McDonald's opening and closing in shorter time than AOL's lifespan. But we move up to the AI risk of failure, and we see that Apple, Meta, some of these companies just do not seem capable of developing the infrastructure or intellectual base to progress in this field, and now they're contracting out. Does that not provide a red flag to you that this AI fallacy might be coming to a short-term close?
Yeah, so are you talking about the deal that they made for their latest data center, where I think they partnered with Blue Owl and some other investment consortium to basically make sure that the debt for this data center wasn't on their balance sheet?
Pretty much, along with other things that they ventured into, which leaves normal investors scratching their head and thankful we didn't invest in their company.
Yeah, I think it's a big red flag when you're seeing, I mean, it just reminds me so much of the metaverse. Zuck has this capacity to really go off on a tangent and throw a ton of money behind something just for the sake of trying to find the next hot revenue source. And I think it's an admission that they're finding trouble with their core to continue to juice the numbers in their core business. And I don't know if you saw the recent report that it was estimated that as much as 10% of all of their advertising sales last year were scam ads. And there was they had quotes about internal meetings where they were like, we're going to try to get these down, but not past a certain threshold where it really hits the financials. So it was like, we're going to scale it down by something like 0.5% per year. It was so scummy to read, and it's obviously based on, anonymous sources. So take that for what it's worth. But it was published, I forget where, but it's just one of the many red flags with this business, where you've got all kinds of scam ads and problems with this business where they're monetizing at all costs. And if you go, I canceled my Facebook account a long time ago because it's just become nothing but a constant ad stream. And same thing with Instagram. And so I think Zuck is just hungry for the next revenue source, the next growth story, and is willing to do whatever it takes to get there. And there was a great quote a few months ago about an interviewer was questioning him, like, so what if we, what's the risk to all this spending? And Zuck's answer was, well, we might end up misspending a few $100 billion, but I'd rather do that than miss this opportunity, which I thought was just a crazy statement to say publicly. And I think that's the plan, is they realize they're saying the quiet part out loud, which is this is clearly an investment mania, and they're chasing the pot of gold at the end of the rainbow that they think is going to be there, they hope is going to be there. But when you see moves that they're making of offloading the exposure to these data center investments to third parties, I mean, that tells you that they are not super confident that buying all these high-priced GPUs from NVIDIA is really going to move the needle in a way fast enough to actually overcome the massive depreciation of these chips and the huge cost of them. And, it's like, where is the revenue that's coming from this $300 to $400 billion in spend? It's not showing up. I mean, we have an AI industry that's generating tens of billions of dollars in revenue, and you can claim that Meta claims that they're making a little bit extra money on their ad monetization, but again, it's how do you parse out what they're making from the AI tweaks to their sort of advertising model versus just jamming more ads down their users' throats and being really lax with things like the scam ads that they have on their platform. And that's why I think the big challenge that Meta has is that they don't have a cloud computing business to use this excess capacity to rent out to third parties. So Microsoft, Amazon, Google, they can maybe afford to be a little more aggressive with this build out because they do have those cloud businesses. Meta is banking on all of this money that they're spending is going to somehow juice their revenue and earnings enough to justify the spend. And that's why I think, that's why you're seeing them offload some of this expense to third parties. And I also think that's why you're seeing the market start to react more negatively to Meta with its latest earnings report. I think at the lowest, we were down 25% from the previous highs, despite a generally solid earnings report if you look at everything except for the free cash flow statement. And that's why my bet is that Meta becomes the first to blink in this CapEx arms race, because they don't have the cloud computing business to offload this excess capacity. And investors have already been burned once on the metaverse. And I think there's probably a lot of scar tissue there. And you're starting to see it in the stock price. It's significantly underperforming despite this, latest kind of uptick. I think that's going to be the company that I'm watching for as the potential first one to have to hit the pause button on this CapEx frenzy.
Well, with a PE ratio of 29 right now, maybe they'll buy OnlyFans to sit there and boost their ad revenues. Okay. I know, bad taste. I love it though. So if we talk about the Mag 7, you got Microsoft trading at 35 PE, Amazon 33, Apple 38, Google 32. As you've established, Microsoft, Amazon, and Google have an actual physical plant location that's marketable and alternative businesses. However, when you look at NVIDIA at 44 times earnings and Apple at 38, and Apple really bothers me only because innovation goes there to die. So at what point do these companies have to become responsible? We've had some guests on, Dario and Ed Dowd, recently. We both had the same question, so I'm going to throw it out to you. You're talking about these giant data centers, but the average build time from groundbreaking, permitting, and completion is 3 years. So you've already lost 3 years of the initial GPU lifespan for that generation. and you're going to be installing or designing systems that are already antiquated. At what point does the market wake up and realize this is fiber optics all over again?
Yeah, no, I think that's exactly right. And that's the big distinction that people are failing to make. So if you go back to the dot-com bubble, if you look at the companies that were actually involved in laying the infrastructure, the telecoms like Global Crossing, and there was, I think, a dozen companies that were involved in digging holes in the ground and putting expensive fiber optic under the ground and running it all across the country. That was the real capital intensive part of the dot-com boom. And then you had companies like Microsoft that were sitting on top of that selling software, which was really a great business. And it just, again, the bubble back then was, it just got to an inflated PE ratio, even though the earnings and revenue continued to grow throughout that cycle for Microsoft. What they didn't do was take part in the extremely capital intensive business of laying fiber optic cable. And if you look at what happened to those companies, they all went bankrupt. And that's the scary part about this cycle, is that the hyperscalers have become the telecom operators of the 1990s. And so the earnings ratios is not necessarily what concerns me, although I agree with you, they are inflated, and especially if you do it on a free cash flow multiple basis. The part that concerns me is they have become the ones that are taking this CapEx burden, and they're taking a huge risk that if you don't find a way to start generating a ton of new AI revenue that's going to really justify this investment, they're going to be left holding the bag. And the real problem is they've become such a dominant part of the market that when this CapEx boom unravels, those earnings are going to dissipate, and they're going to be left at, it's not going to be like the dot-com bubble where Microsoft grows earnings because there's this secular trend. They're going to be nursing massive depreciation losses for years after this CapEx bubble goes, if they don't find a way to generate revenue, which I don't see anywhere on the horizon, and profits from these GPUs, then you're going to be looking at a massive hole blown through the earnings statements of these companies that's going to last for years.
Well, that brings me to yeah, I'm sorry, go ahead. Sorry.
Well, I was just going to say the final point is, so the PE multiples that look reasonable today, I mean, if earnings drop, here's my favorite statistic on this whole thing. You take the 4 hyperscalers, Meta, Microsoft, Amazon, Google, and you add in Oracle. By 2030, they are projected to have spent $2.5 trillion on CapEx. And so let's just take the 5-year depreciation rate. Let's assume that's accurate. That's a $500 billion a year depreciation charge at the end of this decade that these companies are going to be drowning in. And if you compare that to what these companies are all going to earn this year, that depreciation charge alone exceeds their entire combined earnings base. So they're going to be looking at a situation where the earnings are eviscerated. And the real scary thing is, the longer this bubble goes on for, the more they invest in these GPUs, and the bigger the depreciation bill is going to be at the end of the, whenever this thing comes crashing down.
So let's go to the extreme side of the market. And the extreme side is one of the Mag 7s, and then one of the sweethearts, and then one that the government has decided to take a stake in. We have Intel at a 676 PE, Palantir at 392 as of the close today, and Tesla at 297. Once again, assume that we have a 0 to 1% growth rate in the economy. The hole that is going to shoot in their balance sheets should scare the hell out of retail, but everyone still believes the narrative. What say you?
Yeah, I think Tesla in particular, to me, feels like the most absurdly overvalued. They're somehow they got swept up into this AI bubble just because I don't know why, to be honest. It's hard to tell what's causing the price movement in Tesla, but I mean, this is a business that's in decline. I mean, they had 1% revenue growth in 2024. They're negative this year. And it's like, what, we're paying 200 times earnings. It's an auto company. So I think, to me, that's the most egregiously overvalued. And I'm toying with the idea of taking out a short, but I think I'd rather wait, because I think when this bubble comes undone and we enter the overall bear market, because I think Tesla gets a lot of benefit just from markets going up. But when the thing finally turns, it's going to be so much easier to short this once it's already going through $200 a share, because I think it's going to bottom out, somewhere sub 50. That would still be a very generous multiple for an auto company that's, post growth.
I tend to agree. I like the concept. I don't like it because they become more like Apple with stale upgrades and updates. Most auto companies generate at least one or two models within a 2-year period that are new and revolutionary. And Tesla is just upgrading software in existing models. You compare to what BMW and Audi and some of the European EV makers are making. Granted, I wouldn't have one because there's not enough range yet. But you look at that design, et cetera, and the Chinese especially, it's stale. It's stale like the iPhone 16, which looks like the iPhone 17, which acts like the iPhone 14.
Yeah, Tesla's biggest problem is that they've starved the R&D in their CapEx budget, and it shows up in exactly what you're saying, which is they haven't had a new model come out in, I don't know, 5 or 6 years. I think Model Y was, I guess you could count the Cybertruck, but that looks like it was a total flop. They've just really tried to scrimp as much out of the business as possible to maintain the appearance of a decently profitable business. But even with that, you can only, looks like you said, in the auto business, consumers want new cars every year. That's what they're accustomed to, and it's not cool to drive a 10-year-old Model S anymore. So I think it's lost a lot of its luster, and a big part of that is they've tried to do a lot. They've done a lot of short-term thinking in that company, just to try to boost short-term profitability, and I think it's coming at the expense of the long-term brand value of the business.
Do you see a credit risk in the corporate bond market for some of these companies and some of the adventures they've had? I think that we've once again allowed the rating agencies to present some really bizarre ratings on corporate credit, which probably, like 07, 06, aren't justified.
Yeah, I think with the corporate bond market, there's definitely some, I would say, we look at a few individual companies for, we just rolled out a shorting service a couple of months ago. And so we've looked at a few names, like Carvana is one, for example, where there's some real red flags with how they do business and with the loan packaging that goes on with their subprime. I mean, they're one of the most egregious subprime lenders. And I think that that's going to be one of the shoes to drop when this bubble unwinds. And we're actually already seeing a lot of stress in subprime auto. And I think that has not come close to being reflected in Carvana's price, as one example. But I think from a broader perspective, one of the things that happened in wake of 2008 was that the financial regulations on the traditional financial system were so stringent that they basically opened up the door for private credit to step into the shadows and extend. It's kind of like all the high risk, really questionable loans got funneled into this outlet called private credit, because that's the loosely regulated. They were able to step in where there was a vacuum created from the traditional banking system that could no longer make high risk loans. It was just too expensive from a capital perspective and too risky from all the new regulations that came in. And I think that's where we're going to see a lot of real pain. And you're already seeing it. I think one of my favorite indicators for what's going on in private credit land is just to look at Blue Owl Capital, ticker is OWL. They've been one of the fastest growers, most aggressive lenders in this space over the last sort of decade. And anytime you combine a speculative market where there's a lot of shoddy loans going on being made, and you have one of the most aggressive growers into that environment, you just know that they've made a lot of bad loans almost by definition. And that stock is down by, I think, 50% so far this year, and it's probably headed a lot lower because you're starting to see, and it's funny, Blue Owl was going back to our Meta example, where Meta wanted to offload the risk of their data center deal. It didn't come as any surprise to me that Blue Owl stepped in to help put that deal together, because they just have the greatest appetite for risk, as far as I can tell, in the private credit space. And I think that's where you're going to see, we've already started to see some blow ups, and I think we're going to see a lot more.
I think that's fascinating because Blue Owl's the one that's hit the surface lately. But the problem with a bear market or any kind of economic decline is nobody pays attention till the bodies till they wash up on the shore. And at this point in time, a lot of people don't understand that we don't see them because it's in private credit versus the banks as it was in the past during the GFC. With that being established, is there a risk of allowing some of these companies to exist longer and far beyond their usefulness, creating higher, shall we say, sustained dominoes falling style consequences for banks, insurance companies, state pension funds, etc.? It seems that we're not taking into account all of the consequences to this malinvestment.
Yeah, that's really the fundamental problem when you have a speculative environment like this. And it's really the seeds were sown during the last decade when the Fed manipulated interest rates down to zero. And it's like you said, that by definition creates malinvestment because credit is not being priced accurately. It's not being priced on market signals. It's being manipulated by a central planner authority, basically. And I think that we are going to see a lot of bodies float to the surface because all of those mistakes that were made, they have been papered over. And private credit is notorious. And same with private equity. I have a lot of experience with the private equity world and oil and gas in particular. And it's just endemic in this industry to report to your investors. They have so much leeway compared to like the regulated financial industry. The private markets, you're dealing with accredited investors, and it's kind of a free for all where you get to mark what these assets are worth. And what we're seeing now in private credit is that, yeah, that's a game where for a very long time, if you can make up your own marks on the loan values, yeah, you can keep companies alive that arguably should have died a long time ago. And if they would have died, maybe the consequences and the fallout wouldn't be as severe. As you mentioned, it's, if you have a sickness, which is kind of what they've created with this credit system, we've allowed a lot of sick companies to get access to funds that they otherwise wouldn't have had access to. You need to treat that quickly, otherwise it spreads. And what we're seeing now is that, a great example is the BlackRock loan. I'm sure you guys probably saw that. It was to some home furniture company. They had it marked at 100 cents on the dollar as recently, I think, as September. October rolls around and it's, oh, wait, no, it's a zero, actually. How do you go from 100 to zero? It means that the mark was not accurate in the first place and that this company has had problems for a long time. And if it was, a company that was publicly traded and you had audited financials and investors pricing it every day, you would have been able to spot that it would have gone from 100 to 95 to 90. The distress would have been apparent. And maybe if you were an astute investor, you could have kind of, saved yourself some of the pain. Maybe it wouldn't have been as bad. But when you have a private credit company saying, oh, everything's perfectly fine, it's 100 cents on the dollar, no issue here. And then you wake up, a couple weeks later and it's a zero. That's the kind of thing you get when you have, like you said, there's bodies under the surface and we're just now starting to kind of see some of them floating up.
Well, let's move forward to that because I'm going to change subjects on everyone. This is something I don't talk about often, but you wrote an excellent article to this subject, and it's one of the bodies that's floating to the surface and may actually get zapped by Santa Claus from high altitude, and that is the new Kmart. I believe, as you do, that Target is a dead man walking. Is this or is this not their make or break Christmas?
Yeah, I don't know if anybody's been to a Target lately, but it's a bit of a dumpster fire in these stores. And yeah, they've had a lot of problems. The first one was they went woke, and one of our subscribers wrote in, and she was a suburban mom, and she was like, I can tell you firsthand that the one person in the family that if you're a retailer, especially a Target, that's supermarket, daily kind of retail items, the last thing you want to do is piss off the moms in the household. And apparently that all the woke nonsense that they went through a few years ago caused a major revolt among people like her. And she wrote in and gave us this long expose on it. I think she gave us permission to publish it. It was really a fascinating read, but she basically swore off the company, and so did all of her friends in her neighborhood. And admittedly, she leans conservative, like most of our subscribers do. But I think they alienated a huge part of their customer base. That's problem number one. But the second problem is that they are just a subscale, higher priced retailer, and Walmart is really just eating their lunch right now. They didn't make the investments into e-commerce and quick delivery, and Walmart has really stepped up their game in terms of offering I think it's $100 a month and you get free grocery delivery that shows up to your door within like 4 hours. It's just super convenient, and they're going head to head with Amazon, and they've basically become a major competitor to Amazon, and they've left Target in the dust in terms of their e-commerce abilities. And then the third thing with retail is they compete on razor thin margins, and because they have a shrinking revenue base, they are just getting outrun by Amazon and Walmart that have the scale to offer lower prices. And so I think Target is just they're in secular decline right now. And I know a lot of people are maybe attracted because it's trading at something like a 12 times earnings multiple, 5% dividend yield, but I think it's going to end up being a value trap.
Well, that you hit two of my highlights, because I'll be honest, I am a Walmart Plus member, but it came with my Amex card. So yeah, of course I'm going to sign up for it. You're going to give it to me as a benefit. I'm going to sign up for it. It seems that Target's isolated themselves, and the two things that stood out to me are that they failed to prep for the trade war. You knew that Trump was going to win in November. You knew there was going to be a tariff conflict, yet they seemed to make no moves from the end of last year through the summer when everything started to hit the fan, while Walmart was just bringing every consumer good they could imaginable into the country. And then you've had inept management, as you highlighted with the woke garbage. It doesn't seem that they've grasped the reality. Plus, their real estate footprint is just god awful. Even Walmart is close some of their garbage performers. How bad could it get next year for them?
Yeah, I think it could get pretty bad. And yeah, it's, as you point out, I think their failure with the to load up inventory ahead of the tariffs, and also their footprint. They do have some awful locations. I mean, Walmart is just everywhere these days. And I think that's just a part of why they're at a secular disadvantage, is because they just don't have the scale, and they don't have the supply chain, they don't have the retail footprint. And yeah, the management has been just pretty inept the last few years, not making any of the real moves. I mean, they need to basically adopt the Walmart playbook and go for scale, lower prices. And I don't know what they're doing, what their game plan is. I think the challenge with the Target is it is trading at a cheap multiple, and if they can maybe muddle along, maybe they'll just merely survive at this point, or at least for the next few years. But I think this coming holiday season is going to be kind of telling. And their revenues are just getting worse and worse every year. I mean, down 3% in the last trailing 12 months, and Walmart's just knocking the ball out of the park. So if that divergence continues and they continue to bleed market share, then eventually this is going to go the way of Kmart, we think. It's a secular decliner. But I think the hard part about shorting a company like Target is that it's going to be probably a slow bleed. I'm thinking this is maybe a story that plays out over the next 5 to 10 years. And the challenge with shorting a company like Target is if they have really beaten down expectations. So if they come in a few pennies above, or management gives some kind of positive outlook, maybe you get a short-term pop in the shares. But I think if you're looking for a secular short, that you don't mind if it hits, if it rallies 10, 15% on any given quarter on just an oversold bounce. I think this is eventually going to become just one of those things that bleeds out over time, like a Sears or a Kmart.
I think if the thing for Target that is hilarious is if it becomes a single digit stock and they get rid of some of their garbage real estate portfolio, it really might become attractive to Amazon to take Walmart head on, introduce an entirely new retail trade war in the United States, which would be entertaining from an investment perspective.
Yeah, it's possible. You could get a situation. I think that's what kind of happened with that was one of the. Remember back in the day, Macy's was kind of going through a similar decline. They didn't necessarily go woke, but they just were getting eaten alive by Amazon, Target, or Amazon rather. And I think what happened with Macy's with it, they had that real estate value was sort of like the it's what kept the shorts at bay more or less, is that there was this idea that they could monetize the real estate. And so that's when I look back, I unsuccessfully tried to short Macy's because it didn't fully collapse. It just went sideways for, years after it really had issues with Amazon starting in like around 2013, 2014. And you were paying that high dividend along the way. And so it just becomes challenging when you point out that there could be some sort of floor value there with the real estate, or maybe they make some kind of partnership with Amazon. Um, so it's tricky to short these because you've got a class of value investors that will come in and try to, play for some kind of real estate monetization event or something like that.
Well, I'm going to divert back and hit the turn signal one more time, and then we'll close the program out because I don't want to abuse our time. And I don't know how much time you've got left. I don't want to sit there and take all of your evening because it is a holiday weekend. Gold, silver, and copper we've brushed over. And as you know, I'm a gold bug. I'll admit it. I'm a bigger silver bug like you are. I really believe that we have the potential, though, when you start looking at the base metals also, there's a line in the sand for inflation. And if we really do have 2.9% inflation, like we're all supposed to believe as we smoke our crack pipe, you look at what's going on with the metals, which are the basis for all industrial investment and expenditures. The screw energy, we've got access to cheap energy. But if you don't have the metals and mining capacity to stay in the game, there's great potential for this market to advance substantially in the next few years. Would you not agree?
Yeah, absolutely. I think you're going to see. I mean, I think I've heard I think we're going to be running out of things like concrete, aluminum, and I think the metals theme has a long way to run, and especially the monetary metals, because that's the ultimate thing you can bet on, is that there's going to be more debasement, there's going to be more debt issued. I think we're going towards lower rates, even regardless of what inflation does, just because the Fed's mandate is going to be to make sure that the federal government doesn't bankrupt itself from a mountain of interest payments. But the one thing I would say is that, so I'm deep into energy land right now for our next this is kind of becoming one of our big themes, is that I can give your listeners one specific stock idea, because we're actually, full disclosure, already in this stock basically around the price it's trading at now. But I think there's going to be a very interesting opportunity in natural gas, and in particular natural gas in the Permian Basin. Over the last sort of decade of the shale revolution, a lot of associated gas, which is gas produced from people drilling oil wells, they're not targeting the gas, but it just comes up the well as an associated byproduct. And because the Permian has had such a oil boom, there's been a massive amount of gas produced in that basin. And so for many years, you've had a glut of gas where it's been flared off and sold for a deep discount to the prevailing like Henry Hub gas benchmark prices. But what they're doing now is, so you take a look at the Stargate project that was announced, the big $500, it's going to end up being one of the biggest boondoggles probably in history, but they are actually building the thing, and their flagship location is in Abilene, Texas, which is in the heart of the Permian Basin. And it wasn't any, coincidence why they chose that location. It's some no-name town of 200,000 people in West Texas, but what it has is the cheap gas of the Permian Basin, and they're going to be using all of that gas to build power plants to fuel these data centers. And so right now, there's something like 20 gigawatts worth of data centers being planned for West Texas. And to support that, there's an influx of new power generation capacity being built in the Permian. And what I think was going to happen over the next few years is we're going to see the Permian is finally going to have an outlet for all this excess gas. And so what we're looking at is a company called Viper Energy. The ticker is VNOM. And they are basically an energy royalty company. And what I love about the royalty business is they're basically the landholders, and they own a bunch of land in the Permian. They lease it out to drillers. The drillers take all of the risk, they incur all the capex to drill the wells, and Viper just gets a slice of the revenue from every well. And it's just a tremendous business model. They've got like 70% free cash flow margins, 6% dividend yield, and it's trading at like less than 9 times next year's free cash flow. And what I think is going to happen over the next few years is as gas prices rise in the Permian Basin and go from a major discount to trading in line with the national average, Vipers should have a windfall from being able to sell their gas at a higher price, but they're also going to have more volumes coming up because they're going to need to supply a whole lot more gas to all these power plants that are being popped up in West Texas. So I think that is my view is I don't want to buy the companies that are spending all the billions and billions of dollars on the GPUs, but I think it can make sense to buy these key infrastructure components, in particular materials and energy that are going to go into these data centers, especially if you can find companies that are trading at cheap valuations and are high quality business models. I think that's a really interesting way to kind of play the AI boom without taking a gamble on Meta or whatever.
Interesting, and that is something worth pursuing, and we shall do so. But now I promised for one of my listeners I would ask a Bitcoin question. I don't talk about Bitcoin much. I'm one of those old guys who are skeptical. Take that for what it's worth. But is there not a risk with the introduction of Wall Street into the market, especially via the ETFs and other alternative investment instruments, along with whale risk, which everyone dismisses, that if a couple of whales decide to liquidate, the retail investor is screwed, especially on a Sunday morning at 2 a.m. Is this not the tail risk we're looking at in the coins and the market as a whole, as far as alternate meme coins, et cetera?
Yeah, well, I'm right there with you. I'm a Bitcoin skeptic, and that's just one of the many problems that I see with the whole crypto universe. You've got all the big buyers in the last couple of years of Bitcoin that have propelled this rally up to 125,000 plus were Michael Saylor leading them, like sheep to the slaughter to leverage up their balance sheets and become Bitcoin treasury companies. And it looks brilliant when Bitcoin does nothing but go up. But then all of a sudden, it's like you said, we've had reports of major whale liquidations, and all of a sudden here's Bitcoin, it drops 25% in a matter of weeks. And I think that's the risk you take with something like this there's no real way to value it. And you could make the same argument against gold, but with gold, that it's got the 5,000 year track record of history. It does have industrial uses, same with silver. And we know that the central banks around the world are buying it like it's going out of style. So I don't think central banks aren't doing it to create some kind of stock pump so that they can, get a 3 times NAV valuation and create the infinite money glitch. They're buying it because it's obviously the known store of value that they can back their currency with in case, there's a global reset of fiat currencies, which seems like that's kind of where we're heading. But when you look at it at crypto, there's just no reason to believe that it's more appropriately valued at 120,000 versus 50,000 versus 10,000. And so all you have to go with is are there big buyers or are they big sellers? And I think that there's no way to predict that. And yeah, as you point out, we woke up in the last few weeks and a lot of big whales decided to sell, and now the price has been crushed. And there's just I have trouble wrapping my head around what's this thing worth. And I think it's a speculative trading vehicle and really nothing much more than that. So if you can trade it, make money, all power to you. That's perfectly fine. But just know what game you're playing, I guess, is what I would say when it comes to Bitcoin.
Maybe we can get Saylor and Zuckerberg to get married together, because they're two birds of a feather recently, it would appear, in their investing choices.
It'd be a match made in heaven, I think.
I think so too. So I got one big question for you, and then we'll close the show out because you've been so generous with your time and a lot of your knowledge. My concern heading into the first 2 to 3 weeks of December is we seem to have the books closing for a lot of houses this month. We seem to have a lot of activity occurring in the markets that people don't see because they don't understand where stocks actually trade. Do you think we're going to start seeing a real, honest to God, liquidity squeeze in equity markets until the Fed decision and the first few weeks of December?
Yeah, it does seem like we are set up. I mean, it feels like I'm not the liquidity expert. I know Michael Howell is the guy that I sort of rely on for thinking about liquidity, and I think he's been out saying that the global liquidity cycle is due to turn starting in 2026. And I look at my best way to kind of measure the sentiment of the market is to look at what are the most speculative fringes of the market doing. And I think what we're seeing in things like Bitcoin and other really speculative areas, whether it's quantum computing or the nuclear stocks or flying car taxis, you've seen all of these sectors just really collapse over the last couple of months, anywhere from down 20, 30, 40, in some cases 50+%. And I think that's the best indicator that I can follow that says there is liquidity leaving this market. And this little bounce that we've had here in really thin holiday trading, I view it as just very suspect. It seems like that's something it's very easy to juice the markets when everyone's, away from their screens, and you could take a few big players can easily move the markets around. So I am kind of on guard because I think we started to see some real cracks around the market. And even if you look at, like we talked about earlier with NVIDIA and companies like Meta, these AI leaders, you're starting to see some cracks in the narrative and also in the price action. So I think that we're starting to see some early warning signs that maybe there's some cracks under this bull market. And yeah, I think the next 2 weeks are going to be critical. And I'm kind of waiting to see if this kind of low volume melt up is going to continue. But my sense is, if I had to place a bet on it, I'd say that there's probably a good chance that we come under some pressure here once we get some real volume back in the market starting next week, and especially around I think one of the key things is the Fed announcement. It looks like there's 80% chance of the Fed cut. What I would, from a bearish perspective, what would confirm that we're in sort of a change in trend would be if the market sells off even after that Fed announcement, and it's sort of a sell the news event. So yeah, I think the next 2 weeks are going to be critical, and I'm sort of treating this market as guilty until proven innocent, just because of sort of the weakness we've already seen emerging under the surface over the last few weeks.
And with that being said, I expect the biggest, wildest market in the next 2 weeks, like you said, because let's face it, if we get a proverbial hawkish cut, quote unquote, that's not going to end well for equity honks. It's going to look a lot like 2018.
Yep, exactly. I could very much see us repeating that scenario.
Ross, please promote your website, how to reach you, how to follow you on X and any other social media.
Yeah, so again, I'm at Porter & Company Research. I run a trading club product. We open it up once a quarter, and next week we are opening it up. So if anybody wants to join and see what we're doing over there, give me a reach out through the DMs, and I can get you a special discount and get you in the door for our next set of trades. And yeah, follow me on Twitter. I refuse to call it X.
I know the feeling. I feel that way too. Then again, I'm older than dirt. And folks, for you who do not know, Ross and I have had many exchanges on X, all of them positive. We're just here to exchange ideas. I'm not always right. But I tell you what, when you learn from individuals like Ross and his people, you begin to get a better perspective on markets. Speaking of which, MacroEdge.net/ozone, MacroEdge.net/ozone. Folks, 2-week free trial. Don't miss out. And stay tuned to MacroEdge on X for our next exciting guest. For MacroEdge Radio, this is John Galt. Good night now.